the change in accounting standards is coming for quite some time now. There have been reports about the shift in the standards. We've also had conference calls organized at our initiative to educate people on the principles of transition. But I think, as is normally the case whenever transition happens, there is an adjustment that's required. So I think the sails have to be reset, and that's what I think people are trying to do. And to some extent, I think there has been misunderstanding of the quantum because the comparables were not readily available. The comparables that were put out was restricted to a quarter, and the business that we run in, quarter is not a great indicator of how the year is. So possibly the restricted data that was available lent itself to some misunderstanding. But it's a great opportunity for me to clarify some of those.
One issue is the provisioning, the ECL related provisioning, and I mean the inability to be able to predict that. People are very worried about that. How would you respond to that?
See, I think it's a new rule that has come into play. The fact that there will be project receivables is an old story. We've always used to make an assessment of the realizability of these receivables and make provisions as and when we find that they are not likely to be realized partially or fully. But going forward, what the new accounting standards wants us to do is to adopt like what banks do in terms of NPA provisioning. Use a template which is time linked and run all receivables through those templates. For example, if there are some receivables over a certain cutoff date, let's say 90 days, 180 days, 360 days, whatever, the discretion is given to the company to set these cutoffs based on the businesses that they're in. But once you have these cutoff dates, then the receivable, whether in our judgment is good or not good, goes through this provisioning. So to an extent, there is a non-cash accounting charge that gets created. The whole idea is to smoothen the impact should receivables go bad. In project business, generally, they are time drawn, but never have I come across a situation where we have to make big write-offs like banks do.
And you don't expect that to happen? No reason for you to expect that at this point as well? Right?
No, and I think the guidance that we will be putting out on the EBITDA margins will factor in these provisions because which are actually part and parcel of our cost of operation.
The important sort of two words from that is that all of this is non-cash, right, essentially. So actually, even if provisions were to jump, it doesn't make that much of a difference.
No.
Right?
It doesn't. It doesn't.
To cash flows, it does not.
Yes.
Right?
The cash flow does not. It is book provisioning. And to that extent, I think over time, this will settle down because to the extent of provisions that you make and subsequently you realize, there will also be a write back. And which is the reason why I'm saying going forward the EBITDA margins that are given out as a guidance would factor in what is likely to be created as a charge, non-cash, and what is likely to be realized as cash and hence reversed.
Any guidance that you can give me in terms of actual numbers? I'm going to ask you to
see
in terms of provisions.
I can relate to 15-16 and maybe first quarter of 16-17. 15-16, we had to provide something like 350 crores as additional provisions by using a template that has been now prescribed. Now, when I closed 15-16 and announced the results to the market, this was not the rule. So we had, in a sense, understated the provision by the extent of 350 crores. And that is based on the consistent way in which we used to account for provisions. If I were to use the current template to those situations, the margins will deplete to the extent of this 350 crore. If you really see, if I take a step back and look at the EBITDA margins of the core engineering construction segment that we announced in FY16, we announced 10.8%. And that, if I restate based on the new accounting standard for 15-16, will be something like 9.5%.
It will compress.
It will compress to 9.5%. There is a compression of about 130 basis points. Now, this has three elements to it. And it's important that we understand this element because some of it is recurring, some of it is not. For example, all the corporate overheads that we incur in the earlier accounting standard segmental disclosure were not required to be adjusted against the segment income.
Okay.
They were to be kept as corporate overheads and absorbed accordingly.
Okay.
Mind you, what I'm speaking about does not make any change on the PAT of the company overall.
Yeah.
It is just that reallocation between segment and corporate.
You know, so much time has been spent on this, and we were short on time. I'm going to ask you, why is the financial year 16 numbers not been sort of restated in that sense already? And when is that going to happen?
Okay, we have taken a view that all the previous year restated numbers needs to be audit reviewed.
Okay.
And we didn't want to do it based on management estimate of the pre-stated number.
Okay.
Now, given the time restriction that we had time to restate the first quarter of the previous year and get them audit reviewed and presented. And the remaining 3 quarters are under audit.
Okay.
Now, they need to be reviewed, and once they are review ready, at the appropriate time we can do it according to the current requirements of SEBI. We are mandated.
Will you be able to declare the restated numbers along with the second quarter numbers?
Which is what we are evaluating, considering the developments and the clarity that is required around this.
Okay.
But that will be a voluntary disclosure by the company, because according to the SEBI guidelines.
But that will be helpful, most definitely, as we've realized.
At least to ensure that there is clarity about the financial health of the company. Maybe that would be helpful.
Let's move away from accounting, Anisha, right?
Well, yes, let's talk about the core operations. And one concern that the analyst and the street has from the Q1 numbers is the domestic infrastructure segment. Now, that has grown by a paltry 5%. The inflows, the order inflows have actually declined on a year-to-year basis. With West Asia slowdown, the strategy was to start looking back to the domestic operations. Now, in that context, what kind of growth can we expect from the domestic business of the company?
We do expect overall a 15% growth in our order inflow as we speak. We had about 1,38,000 crores of orders that we picked up in the prior year for the entire year, and we expect that to be excess of 1,50,000 crores in the current year. The share of international is expected to be about 30%. And this is not lending itself to quarterly extrapolation because of the nature of the orders and the lumpiness inherent in this business. So we do expect possibly about close to 90,000 to 1 lakh crore coming in from domestic market. In the first quarter, we have picked up about 15,000 crores of that. So in one sense, about 15-16% of what we need to do in the domestic market, we have done in Q1. We generally, as a company, have been more prone for Q3, Q4, more for Q4, and that's how the domestic orders gets placed, and we are helpless in that situation. We would like the orders to come in more evenly, but they don't seem to. So if I look on historical trend and look at the pipeline that we have and the possibilities of winning the orders, retaining the strike rate, we do think a 15-16% accretion in the first quarter sets itself on the road to reach that 100,000 crores.
Well, yes, that's about the order inflows, which hasn't been a big problem this time, but what about execution? So the revenue has been up 9%. The guidance is for 12-15% growth over the year. Now, this sets the run rate higher for the coming quarters, and as it is the high base that we have of last year, would the road meeting revenue guidance be a challenge?
No, I think we did that assessment when we announced our quarterly results last week. Our businesses do confirm that the gradient is scalable, that the revenues will pick up. The first 2 quarters will be slow. Historically, that's also been the case, and much of the construction work which happens outdoor during quarter 2 will have very poor progress. So what gets ordered out, what gets done on the engineering side is what will add up to revenue. So the first 2 quarters will be weak. But our plan of execution, if you are able to stick to it, we should be able to see improved revenue in quarter 3 and much improved revenue in quarter 4. So based on that assessment, we do think that 12-15% band on the restated revenue of FY16. FY16, we announced a revenue of 1,03,000 crores. That, when I restate, is something like 1 lakh crore, which is about 3,500 crore.
I think the point also is the third quarter and fourth quarter of last year, financial year 16, the base is extremely small. So the second half of this year, 17, should be spectacular. I mean, it should be pretty good, right?
Yeah, it should be good.
Seasonally also, there are stronger quarters, as you said.
Absolutely.
But the point my colleague was making is, away from seasonality, has Q1 been weak operationally as well in terms of execution? I think that's the point.
If I were to benchmark it to what our internal plans were, I think we are on the plan.
Okay.
We are on budget. We are not lagging behind. So that gives me some hope that the rest of the quarters, the businesses will be able to stick on to the budget, and if they do, 12 to 15% is there, as we can see.